Thanks, Tom. Again, Scott Forehand. I'm with Symmetry Financial Group, and we're here today to talk about debt-free life. And then we're going to talk about one little bonus thing here towards the end. Wanted to mention, I think we talked about this last week. I just want to make sure everybody's aware of it. The Secure Act went into play this year, and the Secure Act is another one of the reasons why a debt-free life campaign will outshine and outgrow a 401k, 403b, 457 FERS, TSP, all those plans. And basically what the reason why is because based on the Secure Act previously, if someone passed with one of those retirement vehicles, the beneficiary of those retirement vehicles on the person that passed could actually take the funds out of those vehicles over their lifetime. And now with the Secure Act in place, you no longer have that option. You have to get rid of the funds. You have to liquidate those funds or transfer them to you within 10 years of when the original person passes. So it's put a significant damper on the ability to use those incomes and those monies for income for a long-term period of time. Couple other just points of business. The debt-free life campaigns that we talk about these days are going to do a couple of different things. Obviously, we're going to get you out of debt. That's why we're talking about debt-free life, but also we're going to really supersize your retirement plan and make sure that the beauty of that is that it's a tax-free retirement. And that you're gonna, and the nice thing about this is you're gonna have complete control over these plans, and the IRS is not going to be able to stick their nose in here and tell you what to do and what not to do. You can also be looking at, the tax implications are amazing, and we'll get into it. So hold on one second. Let's go ahead and get started. So here's the screen. Debt-free life. Tom, I cannot see your face at this time, but if you would make sure that that I'm showing my screen correctly.
You are, sir.
All right, thanks. All right, very good. So this is debt-free life, and this is a proprietary product that was started being offered by Symmetry Financial Group in June of 2019. So we're just now at the 1-year mark with this program. This is not anything new. Well, actually it is. Debt-free life is new. The concept has been around for a long time. This is coupling two basic financial instruments. One's called infinite banking and the other's called debt snowballing. Those two concepts have been around for a long time. The problem is the previous iterations of this solution that came before us, they always had holes in them, and there always was an Achilles heel with each one of those plans. So what Symmetry's done with DFL is debt-free life is we've actually figured out where those Achilles heels were with all those previous programs, and we've eliminated those holes, and we've stopped up the holes in the bucket, and now the bucket works the way that it's supposed to. So welcome. If you're here at this meeting or at this presentation, you're one of three people. You're either you're an agent with Symmetry looking to get a broader understanding of debt-free life. You're a client from one of the many brokers and underwriters that we have here at Symmetry, or you're one of my clients and you're here because you listened to what I said and you're just here to learn, which is great. So debt-free life is actually a play on words. It's a plan that uses debt, your debt, whatever that debt is, in the form of in a vehicle that is a life insurance policy to eliminate its debt. So basically we're using your debt to eliminate your debt, and then we're using that to create a huge retirement. So congratulations on finding the hottest retirement solution on the planet right now. Growing leaps and bounds. It's crazy. So when we're looking at debt-free life, we're taught to ask a couple of basic questions. The first is, are you 100% sure that you're going to have a solid retirement? And I don't know anybody that can answer that, except for maybe a financial advisor, financial planner that does their own plan and manages it every day. and those people are sure that they're going to have a good retirement because they're not going to let themselves have anything less. The problem with that is that you have to manage it, maintain it every day. And if you're not one of those people to pay a financial advisor or planner to manage that for you, you're probably going to have to give up a substantial chunk of your profit to have them do that for you. Our debt-free life system is zero cost. It manages itself with a little bit of tweaking from time to time as you go through this process. The other question we ask is if we can show you a way to get out of debt in 9 years or less, including your mortgage, is that something that would be interesting to you? And the truth is, when you run a lot of these solutions, a lot of these illustrations, you realize that it's not really 9 years or less. It's actually 15 to 27 years early, which is from my perspective, actually a much better number. If I can get you out of debt in 15 years, or I can get you out of debt in 23 years faster than you had planned, or 27 years faster, it's probably a better deal for you, especially considering not only are you getting out of debt, we're keeping a substantial portion of that money that's going to be used for your retirement. And it's going to be a tax-free, tax-exempt retirement as well. So if you're an average American, this kind of describes you. You spend about 34% of your money paying interest payments. You pay about 40% of your money paying taxes. You pay about 23% of your money on living. That's your lifestyle money. And then about 3% of your money you save. This is absolutely not what the founding fathers had in mind. This is anathema, would be anathema to them. And the whole idea here is that we as Americans are doing well, but we're not saving enough. We're spending too much on interest. We're spending too much on taxes. And the reason why we're doing that is because we're taught to from the beginning. Taking a kind of a cross-section view of the average American, we make a lot of money. In the working years between 20 and 65, the average American makes about $2 million in their lifetime. That number is probably actually a little bit low. We're probably higher than that at this point. And even though we make that much money, the critical issue here is that we don't have enough for retirement. So in the process of taking on those debts as we get older, we're taught at every corner in life that it's okay to take on a debt. It's okay to take that car payment out. It's okay to, buy that house, get married, pay for college, do all that stuff. We're taught it's okay to do that. And the problem is, by the time we realize it's not okay to do all that, it's in most cases too late, unless you're lucky enough to have run into a debt-free life agent, broker, underwriter who can show you a different path. These plans work, by the way. I've run these and put these in place for people up to 75 years old. So it's not too late. You've got time. Let's see. Here's our traditional approach. If you look at go to a debt manager, debt consolidator, credit counselor, these are the things they're going to tell you how to get out of debt. They're going to tell you to go get a second job, spend less money, go eat ramen and tuna fish, refinance, consolidate your debt, whatever. These are the solutions that they show you. And the problem is only one of these works consistently, and that's that debt snowball down there at the bottom. Working harder is not something that's tenable. You can only work harder for so long. Spending less, that's not fun. Saving more, same thing as spending less. Refinance, so you're exchanging one debt for another debt. Consolidating, you're exchanging all your debt for one debt. They don't work as advertised. And in most cases, those plans typically fail 4, 5, 6 years down the road. We're going to show you something different. So, and there's something different we're going to show you is what we're talking about right now. This is a better way. So if I can eliminate your debt, which I can, or any of the other agents here can for you as well, and I can show you a better way to spend your money more efficiently, to put you in a situation where you're spending money in the most efficient way possible and actually keeping a lot of that money just through course of normal business, then you're going to come out way better in the long run. We're going to increase your cash flow. We're going to increase your retirement. We're going to allow you to leave a legacy for your family that you've never thought about, a humongous legacy in many cases. And we're going to put you in a position where, if you desire, you can actually create generational wealth. This is not new. This is not some kind of magic. This is something that's been done by the richest segment of our population for years. They understand how to use the system to their benefit. And that's what we're doing here. We're using IRS tax code 7702, and we're using and operating within the limits of that tax code to make the numbers work for us, to make our debt work for us. So our two systems, where you are right now, the average American with $250,000 of household debt, that includes your home, cars, credit cards, student loans, personal loans, the loan for the braces on your child, the loan for the procedure your dog had to have, whatever. It's all debt, and you're on the hook for all of it. And that's the average American. What we're going to get you to is that right side of the screen, where you're no longer saving only 3% of your savings. You're saving 15%. We're going to increase your retirement savings by 500%. Yes, big number, right? We're going to decrease the amount of interest you pay over time from 34 to 22. That's actually a 35% reduction. We're going to decrease the amount of taxes you pay over time. That's a 25% reduction. And we're going to increase that lifestyle. What's that lifestyle number? That's the money that you live on. That's the money you pay your bills with, that you put food on the table with, and whatever's left over, maybe you pay your Netflix bill or your Hulu bill or whatever, and you do whatever entertaining things you can possibly do. We're going to increase that monthly tax flow for you by 10%. Really? Is it 10%? It's not. Going from 23 to 33% is actually a 43% gain in how much you're going to be putting aside, or how much you're going to have left over. So think of it like this. If your current situation is at the end of every month, you've paid all your bills, you've done whatever you want to do, and you've got $1,000 left over, simply by executing one of these plans, you will get to the point where instead of having $1,000 left over, you'll have $430 left over. And that's an additional $5,000–6,000 a year. That's a lot of money for many people. So this is what we're going to do for you. I'm going to show you how we're going to do it in just a second. So by getting to this point of where we want you to be, where you have that 500% increase in your savings, and you're actually saving about 15%, 15 cents of every dollar you make, we're going to do this. We're going to attack it from a couple of different directions. Mainly, we're going to get rid of those taxes, or some of them. We're going to get rid of that interest, or some of it. We're going to create that huge retirement piece. Get rid of that huge retirement piece, and ultimately that little text line there about eliminate all your debt in 9 years or less. No, it's 15 to 27 years early. One thing that a lot of the other solutions that came before us failed to do is they failed to recognize that life happens. You can have a plan, and all plans change over time, but if you don't plan for the most unexpected thing, that emergency, and you don't have the right amount of emergency funds available to you when you need it, then your whole plan is going to come crashing down. It's going to fail. And that's what happens most of the time with those other solutions that are out there. So what we've done is we've structured the plan that we use where we're going to have an emergency fund built in, and it's going to be about 20% of the total cash available to you, but we're going to hide it. It's not that we're we're intentionally hiding it from you. It's in there. It's in your system. It's just you can't easily get to it. So this is one of those out of sight, out of mind things, because we don't want you to make that emergency jet ski purchase or that emergency trip to Tahiti purchase. Those don't exist. You need to buy a new car because your car got wrecked. You need to put a new transmission in. You need to put a new roof on your house. Those are true emergencies. You need to buy a new refrigerator. You need to fix your AC. Wow. Those are true emergencies. That other stuff is not. So no matter what the solution says, at the end of the day, when you're looking at the value of your plan, there's still an additional 20% hidden that you can get to if you need to. And it's cash. It's your cash, and you can get to it, but we don't want you to touch it, and we don't want you to make it easy to touch. One of the key things about this whole process, this whole plan we're going to talk about, is this, and this is important. You are never going to pull out the principal of your plan. You will only ever take a loan. And as long as you do that, you'll never have a taxable event, and you'll never be able to defeat the plan. The plan will always work. Okay. So when we compare traditional retirement vehicles, whether it's a Roth vehicle or a traditional IRA, When we compare it to a tax-free retirement vehicle like this, beyond just the discussion of having the IRS tell you when you can and when you can't take money from it, tax you when you do take it, penalize you if you take it too soon, tax you whether you want to take it or not when you turn 72, regardless of those things, because this plan doesn't have any of that. Just simply using a tax-exempt vehicle means that you're not growing the tax that you owe Uncle Sam. And that Roth IRA and that traditional IRA, 401k, TSP, all those have that built in. You're going to be, if you're growing and you're having growth, then you're going to be growing the tax exposure that you have when you start pulling it out. One more thing, those two vehicles, they can either make a guaranteed return, which is pretty low, sometimes 2%, sometimes 2.5%, sometimes 3%. And that's just basically what you would be getting from a savings account, a high earning savings account. Or if you really want to make a good return on those, then you have to have your money invested in the market or exposed to the market in some way. And if your money's invested in the market and you can have a gain, then you can sure have a loss. And lots of people have discovered that their money was not as safe as they thought it was. That 401k that they thought that they were going to be retiring with is not where it is. They've lost 20 or 30%. We've had some good gains recently, but they've lost 20 or 30% this year. And that's the nature of those vehicles. They go up and down, and that's okay. Our system, the way that we do this, we don't care what the market does. We're not invested in the market. We're not indexed to the market. The market can go up, down, or sideways. We don't care. We're still going to have our gains. Our gains are guaranteed, and they're high. We're going to get a 4% minimum return every year, plus a dividend on top of that. And in some cases, the dividend is high. In some cases, I've seen it not recently, but there have been some years where the dividend was double digits. So whenever you map out these plans, this is just kind of a cursory example, what you see on your screen. But if you actually graph out how one of these plans would work in comparison to a 401k over the last 20 years of performance of the market, our plan will have a greater gain after you take out the costs associated with managing that account by your broker, take out the cost of the taxes that are growing, and take out the cost of just being in there and spending your time managing that piece. Our system will outperform that annually 17 out of 20 years. And when you look at the 20-year run, the number that we have at the end of the 20-year run is what you see on your screen right now. It'll be significantly higher. There will be some years where the gain will be greater in a 401k or a TSP or a Roth. But over time, over a 20-year run, it's not going to outperform this vehicle. It can't. The only way that those vehicles can outperform what we have is they would have to have a 12% gain every year, 9 out of 10 years. That doesn't happen. It's never happened in the history of the stock market. So moving on. So our system works in 3 phases. Phase 1 is the maximization phase. This is where we're going to look at your debt. We're going to analyze your debt, and we're going to show you the fastest way to get out of debt. Rest assured, there is a single fastest way. Our software will tell us that way. And in the maximization process, we're also going to grow faster than you thought possible because of the effect of compounding along with debt snowballing. After we've got you out of debt, you're going to move into the accumulation phase. And this is going to be for a period of time that you determine. Most of my clients are running these solutions for about 20 years, in some cases 25 years. And for very, very young people, they're running for 40 years. But the point is the accumulation is up to you. You decide how long you want to run the plan and then how long you want to let it grow before you start getting to the next phase, which is the distribution phase. One of the things I just said is really important. When you decide you want to get into the next phase, the distribution phase, what does that mean? That means that I'm looking at the IRS is going to tell you that you have to take money out at a certain age. The IRS is also going to tell you that you can't take money out before a certain age. That's with a traditional retirement account, TSP, IRA, whatever. Our system tells the IRS to go pound sand. We don't care. The IRS can't tell us what to do. It's our money. We own it. We control it. And that's the beauty of this system. If you don't want to wait to 65 to retire, you don't have to. you can actually create a regular residual tax-free income with these vehicles, and it does it pretty quickly. So 3 phases: maximization, accumulation, distribution. Maximization, getting rid of debt. Accumulation, building your retirement. Distribution, taking your retirement. And all these things are done at your discretion. Next, I mentioned earlier that this is not new. This has been around for a long time. These are 4 people that have done it. Ray Kroc with McDonald's used this when he started building his first couple of McDonald's units. Doris Christopher did it when she started Pampered Chef. Walt Disney did it. Berkshire Hathaway with Warren Buffett does it to this day. It's not a new concept. It's just previously, if you wanted to do this thing, you had to know somebody in the insurance industry, a high-level insurance executive. You had to have their ear. You had to have a whole lot of money, and you had to convince them to create a unique life insurance plan for you that would allow you to get paid a larger interest rate and dividend than what they were going to charge you to take a loan against the money you had on deposit with them. So this is like a CD on steroids with your bank. Okay, same kind of concept. So we're going to direct the inefficiently used dollars. And if any of you have any debt out there, then you absolutely have inefficiently used dollars, especially if you've ever thought, hey, I'm going to pay an extra 20 bucks on that credit card to help pay it down faster. That's an inefficient use of money. And it doesn't sound like it, but we'll show you how in just a minute. And all these other things that you see on the screen are what we're going to do. And how are we going to do it? We're going to get there right now. How are we going to do it? Well, actually, hold on one second. Let me get to this. Yeah, so these are some people that we've helped as Symmetry agents. These are very old. These are probably from July of last year, after we first got started. And these numbers are pretty small: 100,000, 73, 84,000. We actually are able to eliminate a lot more than that, and we do with regularity. I'm looking at recently 1.25 million for one of my clients of debt eliminated. So moving on, how do we create a scenario where you're spending money more efficiently, or at least using your money more efficiently? So in order to get to that point, we have to understand what you currently do. So here's what you currently do. You make money. You work your job, hourly, salary, whatever, doesn't matter. And as you make money, it gets deposited into your regular banking account, your Wells Fargo, Citibank, Chase, whoever you bank with, doesn't matter. And then over time, as you put your money into your bank, that bank uses your money over and over and over again. And occasionally they are nice to you and they say, you know what? We're not going to charge you to put your money in our bank. We're going to let you put your money in our bank for free, as long as you keep a certain level. As long as you keep $2,500, $2,000, whatever. Or in some cases, the banks are catching on that that's a really predatory practice, and they started saying, yeah, put your money with us. We're not going to charge you a dime. Okay? So that's what they're doing with your money. Your money is sitting in their bank. They're making money with your money over and over and over again, and they're not giving you any of that. And then all of a sudden, it comes time to pay that bill. And you say, wait a minute, bank, I need to pay my car payment. So you send a paper check off to the car company, the lender, or you instruct through your bill pay for the bank to pay that debt. And in the process of paying that debt, you've transferred your money to them, and your money is now their money. And that money's gone forever. You never see it again. And if you're really nice and ask really pretty, can I have my money back? The answer is going to be no. So you have put your money in a place where you're not earning anything with it. It sat there. The bank used it over and over again. You told the bank to pay your debt. The bank paid your debt. You've used your dollar one time. That's it. In the process of having your money in that bank, the average bank lends your dollar out 7 times before you actually use it, because they're lending it out every night on the federal funds rate. So they're making money with your money every night, and they're not sharing it with you in most cases. And always, in the end, your money's gone. You've used it one time. So there's a better way, and that's our way. This is how we're going to get you to that point where you have true freedom, where you are truly debt free. So same scenario: you make money, salary or hourly or 1099, doesn't matter. However you make money. That income gets transferred into your bank, into your checking account. Again, whoever you bank with, doesn't really matter. Here's where we change the game. Instead of us leaving our money in that checking account for the bank to use over and over and over again, we're going to make a premium payment on our life insurance policy. Remember, I told you in the very beginning, this whole thing was based on IRS tax code 7702, which says all monies derived from a life insurance policy are tax exempt. So we're going to use a life insurance policy to derive our money. Okay. How are we going to do that? We're going to buy a whole life policy. This is a special kind of whole life policy. This is called a participating whole life policy. What does that mean? That means that because you are buying a participating whole life policy, you are able to participate with the carrier that's providing your policy. You're able to participate with their profits. The three companies that we use to do this are all what's called a mutual company. And what that means is because they have a mutual company status with the IRS, they have to pay out a higher portion of their profits to the shareholders. So when you become a life insurance policy owner with the carrier, one of these three, then you become a shareholder. And because they have to pay out to maintain that tax preferred status of a mutual company, they have to pay a higher portion of their profits out to the shareholders. So simply by taking a life insurance policy out with these carriers, you will become a shareholder and you will become eligible to participate in their dividend program. And all three of them pay dividends. A little bit more. So I mentioned that the IRS tax code says any money derived from a life insurance policy is tax exempt. The other side of that coin is, and the IRS does protect itself, it says, look, we know that some people are going to be using this as an investment vehicle. So we're going to monitor that. And if at any point, if the life insurance value of that life insurance policy is exceeded by the cash value of the life insurance policy, then the game's up. We know it's not a life insurance policy anymore. We know it's an investment plan, and we're going to call it what it is, which is, at that point, it is called a modified endowment contract. And the game is really up at that point because everything just became taxable. So our plan is we're going to shield that whole life policy with a term life rider. So it's nothing more than additional life insurance, but it's really, really cheap. And it's not permanent. It's only going to last for a certain period of time. And that period of time is basically going to be however long we need to shield this to where the IRS can't look at it anymore. In some cases, it's 7 years, 10 years, 12 years, 20 years, whatever. It's different. That's why your professional, your broker, underwriter, agent will be able to structure this properly for you. But the point is that term life rider that we add to the whole life policy is going to create an umbrella that's going to shield your whole life policy and the cash value of that whole life policy from IRS intrusion. The IRS won't even be able to see it because all they're going to see is two numbers. What's the cash value? 20,000. What's the life insurance value? 400,000. Okay, we're good to go. Okay. Now, those two things have been around for a long time. This next piece is how this plan actually works. And that's because when we make our single premium payment to go buy that whole life policy, we make that payment every month in most cases. We're buying a term life rider also. So the policy, the check or the payment that we send up is getting split. Some of it's going to whole life, some of it's going to term life. Most of it is going to buy what we call a paid up edition. So let's talk about that for a second. So what is a paid up edition? Paid up edition is nothing more than life insurance. It is just like whole life in that it will last for your whole life, but it's pretty special beyond that, which is this. Once you pay for it, you never have to pay for it again. It is permanent. So when you buy $1,000 of paid up life insurance, tomorrow it's worth $1,000. Next year, it's worth $1,000. 20 years from now, if you're still alive, it's worth $1,000. And when you finally pass, it's worth $1,000. So this is what the banking industry calls a tier one asset, which means tier one means it's the safest asset. There's no risk. It's worth exactly today what it'll be worth tomorrow or 10 years from now. Moreover, most of those assets, there's a fee associated with managing those assets. There is no fee to manage a paid up life insurance policy. There's no broker that's going to take some money every month to manage it. It's not like that. It's a zero cost, zero management solution, and banks recognize the value of paid up additions to the point. Wells Fargo is the example I like to use. 48% of their assets are in tier one assets, and most of that is structured in life insurance. They actually go out and buy life insurance policies. So you've probably seen or heard those radio or television ads. If you've got $100,000 or more of life insurance and you're thinking about canceling it, don't call us first, right? Those are biatical settlement companies, and their whole goal is to go out and buy cheap life insurance policies that are going to have permanent value and keep them. And that's how they make money. So when you make your premium, about 21% of your premium goes to pay for your whole life policy. About 11% goes to pay for your term life rider until you don't need it anymore. And about 68% is going to buy those paid up additions. As you buy those paid up additions, there's a bucket that's your paid up addition that's growing. In your whole life policy, there's another bucket that is cash. That's true cash. If you need to pull it out, you pull it out. You want to take a loan against it, take a loan against it. The way our plan works is, though, we're going to be using that paid up addition bucket to provide what we call the paid up bank capacity. Okay, so that means however much money is in there is going to determine how much money we can borrow from this plan. And oh, by the way, remember that little red circle that was hovering over the bank before, where the bank was making money with your money over and over and over again? Well, after you move your money into this bank by paying your premium, that little red circle is now hovering around your money, which is now in your bank, your debt-free life bank, your DFL bank, and your money is growing in perpetuity. This is a critical concept. If you put money into your bank one time and you never ever take it out, but you take loans against it, then your money is always in there growing. And this is a critical feature of these plans. If I put $1,000 up into my paid up additions, I'm going to borrow $1,000 next year. My $1,000 is still in here growing. I'm getting a guaranteed 4% interest plus a dividend on top of that. That's what I'm banking on, to excuse the pun. So when it comes time to pay my debt, this is also a critical piece here. How do I pay it? So normally I would just write a check out of my checking account, which is how you're going to do it anyway. And that doesn't change. You're not writing a check from your DFL bank. This is not how that works. Remember, what your DFL bank really is a life insurance policy that's growing cash value. But when I need to make that payment, I'm simply going to go into my bank, and let's say we're towards the end of the run and I need to take $2,000 to pay off my car. So I tell the carrier I want to take $2,000 out of my plan. I want to take a loan against my paid up addition bank value. I'm not using my money. I'm using the carrier's money. I'm going to deposit that back into my checking account. And then I'm going to use that checking account to pay that debt. And then finally the debt gets paid, and that money becomes their money. So in the previous example, your money became their money. And in this example, this is the debt-free life method. The carrier loan is what's supplying the money to pay that debt. So the carrier's money becomes their money. Your money is still sitting in here earning an interest rate. And in some cases, the carriers will compound that interest rate on a monthly basis. So these plans fly, and they're fantastic. So in our scenario here, we're going to put you in a situation where you get to use your dollars over and over and over again. You're going to make money with your dollars over and over and over again. And at the end, let's assume you had $100,000 is what you owed on your house. And instead of making a $100,000 payment and paying off that house, you're making your payments up into your bank, making your normal loan payments. And then when there's enough money in your bank, you're pulling out a huge chunk and you are paying off that mortgage in one shot. In the process of doing that, you've kept all that money that you would have been paying over the course of the next few years, not only in interest, but also the principal payments. You've captured that forever. And that's why these plans fly. So let's look at a couple examples. First thing is a standard family. This is a group that I helped last October. It's pretty simple. They have a lot of debts. That was a blended family. They had both been married before, so they actually have two residences. They have a private, their personal residence, and a regular property. Um, the wife was a doctoral student, so she had some pretty significant student loans there. Looks like $108,000, and then they had their traditional other loans. They had a couple of tax issues that they were working on, some credit cards, car loans, that kind of stuff. In their current scenario with a student loan in there, they were looking at 40 years before they were going to be debt free. And they were in their 30s, so that's okay, but they're going to be in their 70s before they were debt free on the current path they were on. So what did we do for them? Well, we showed them the light, which is they were going to be paying $182,000 in interest over the course of the next 40 years. Their true debt right now, if they were able to write a check for $585,000, that little blue circle on the left, then they could pay off all their debt at once. Most people that I know that I've run into don't have $585,000 laying around, which means that their debt is financed, which means when we look at debt, we have to look at it honestly, which is your debt isn't just the principal amount that you owe. It's the interest that you're going to pay along with it. So when we look at this family, they were going to end up paying $767,000 back over the course of the next 40 years. The good result of that would be they would be debt free. They'd have full equity in two houses. The bad result of that, they got nothing left over for retirement. Their houses are their retirement. And that, unfortunately, is kind of a standard that we see these days. And again, you're on this call, you're on this presentation, you're here to look at debt-free life, and debt-free life is going to show you a better way. One thing I want to stress here, we're not looking to create a new bill. We're just looking to change the way, remember, spend your money more efficiently. So if you've got that credit card that you're spending $120 a month where the minimum payment's only $60, this is where we're going to find the money to fund your plan. We're going to find it where you're making overpayments. We're potentially going to look at other life insurance policies that you're overpaying on. We're going to look at over contributions to your 401ks, your TSPs, and we're going to consolidate those funds and make that money work for you permanently. You know, by the way, you're going to get a heck of a retirement out of this at the end, and you're also going to get a humongous life insurance policy. Moving on. So this is what our plan did for them. We got them out of debt 7.8 years. We went from 40 to 7.8 years. Let that sink in for a second. That's a lot. So think about this. We shaved 32 years off of their current debt management plan. So in that 32 years, if they're not making those debt payments anymore, moreover, if they're not making those interest payments anymore, where's all that money go? What do you do with it? This is how we're able to supersize people's retirements. This is how we're able to get people out of debt free fast. So if you look at this particular scenario, this family had 9 of their debts. Think 1, 2, 3, 4, 5, 6, 7, 8, 9. Yeah, there's 9 debts they're paying off in the first 11 months. And one of the things that I talked about earlier is debt snowballing. What we do here is true debt snowballing, not debt stacking. So if you look at those interest rates, we are not necessarily paying off the lowest interest rate first, because that's not the best way to do it. That's not the most efficient way. We're paying off those debts in an order that creates the biggest debt snowball the fastest, so we can then use that money to pay off the next debt faster, and the next debt faster, and the next debt faster, and so on. So this particular plan, this family had an option. They could choose to do the plan or not to do the plan. If they decided not to do the plan, they would have been spending $182,000 in interest over the next 40 years. They'd be debt free with 100% equity in both houses. Choosing to do the plan, they're out of debt in 7.8 years. We saved them $70,000 in interest. And oh, by the way, where they would have been in 40 years with a goose egg for retirement, on this plan, they've got $4.8 million. And moreover, they've got a huge retirement, a huge death benefit on top of that. So when I said earlier, how do we create a legacy? This is how we do it. How do you create generational wealth? In this family's perspective, in 30 years, they take out $1 million, start another one of these plans for one of their children or grandchildren, and they've just transferred wealth from generation to generation. And that's how you create generational wealth. So a couple things to look at. This is the actual yearly plan about paying off the debts. A couple things I'd like to take a look at here. They're debt free at the end of the 8th year, but look at this growth: 272,000 in year 10. That's the cash value of their plan. 375,000 in year 11. This is after only 11 years. Not only are they debt free, not only are both houses paid off, all the mortgages are gone, student loans gone, everything's gone and paid for. They also have now $375,000 sitting in an account that they can do whatever they want to do. IRS can't tell them not to take it. The IRS can't tax them when you do take it. The IRS can't penalize you if you take it too soon, because there is no too soon. You can take it whenever you want. One more critical piece about this: because this is a life insurance policy, it is exempt from torts. That means that if you get in an argument with your next door neighbor and they want to sue you, they can't list your life insurance policy as a possible source to pay the suit if you lose. The money's yours forever. Nobody can make you take it. Federal judge can't order you. IRS can't order you. Your next door neighbor, because you wore a pink sweater and they want to sue you because they hate pink, can't tell you to take it. So one last thing. This is a standard family. They've got debts. They got a lot of debts, and they've got big debts. Okay. What about somebody who doesn't have any debt? Not really, not debt to speak of. So I did one of these plans also back in October on a student. So these plans work for students. So this is a college student. She's 23. She's currently in a master's program, and she's got a lot of debt. Most of it is student loan debt. And that's because obviously where she is right now, she doesn't make a lot of money. She works as a waitress. She pays a little bit on her student loans, but most of the time it's actually 2 of these are in deferment, I think. But the bottom line is, in her current situation, this is beyond the additional student loans that she's getting ready to take out. In this situation, she's going to be having a huge debt issue. She's going to be $85,000 in debt when she graduates. Now, it's probably going to be closer to 110. But more importantly, look at this. That $85,000 in debt that she's got right now, that's going to earn her $91,000 in interest. That's just interest. She owes more than double just because of the interest. Student loans are vicious. All right. So what do we do for her? Well, we took her out of debt in 9.7 years. Now, this is a college student working as a waitress doing this plan for herself. She's got $350 a month going into this plan, and she can afford that. That's it. So now, instead of her loans being in deferment, she's paying them. Now, instead of those student loans growing every month, compounding every month, she's paying it. She's paying off her car fast. She's got a vet bill. She's got a hospital bill because she went to get seen when she was outside of her network. So these things are normal. This is a normal solution. I just did another one of these on another 21-year-old student today. Okay, same kind of situation. On $250 a month, still works. On $120 a month, still works. Okay. So her solution, what did it cost her? So she is going to be out of debt in 9.7 years. She's going to save $64,000 in interest. That's huge. Where'd that $64,000 go? And went right into her pocket because she's not spending it. What was her cost not to execute this plan? Well, in 40 years, when she's 63 years old and ready to retire, she'll have $603,000 sitting in this bank. Moreover, she'll have another $400,000 life insurance policy on top of that. So a 23-year-old got herself out of debt, put herself on the straight and narrow financially, and put herself in a situation where she will be able to create a legacy automatically for herself whenever she has a family and create generational wealth. How to work? Simple. We just followed the plan. The system knows the best order to pay off the debts. The system knows that there is absolutely a single best way to do it, and that's what this does. Moreover, I want you to pay attention down here. Year 33, she said she wanted to retire at 65. This plan has her retiring at 55. So from 55 on, she doesn't make a single payment into the plan. The plan is simply growing. It has become a juggernaut simply by turning those debts on their head and using them as a fuel for a solid financial plan, long-term financial plan. So in this scenario, in year 33, She hasn't paid any premiums. The policy has grown to $431,000. It grew $22,000 over that year, and she didn't make a single premium payment. Moreover, it grew $22,000 tax exempt. She could take $22,000 that year if she wanted, and she won't hurt the plan. The plan will continue to grow. So she can take a $22,000 a year payment tax-free every year for the rest of her life, which means basically if she wanted to, at age 56, she will have given herself essentially a $35,000 raise if we think the tax rates are not going up. And if there's anybody out there that thinks the tax rates are not going up with all this money they're spending on COVID, we need to have a talk. And I've got some stuff I want to sell you. There's a specific bridge that I think you'd be interested in. All right. So that's the end of this. This is a solution that works for everybody. It's something that it's not rocket science. It's really just making your money work more efficiently and work better for you. So if you would, I'm gonna hold off on questions for right now, and I'm gonna start the second part of this. This is a new part of the presentation. This happened because we've always said that the more debts you have, the better the plan's gonna work for you. And hold on one second. So the more debts you have, the better the plan will work for you. One of the things that we look at is, and one of the things we tell people when they look at this stuff, when they try to get into this, is if you can put yourself in a situation where you $100,000 in debt, one debt, versus $100,000 in debt, 10 debts. That $100,000 in debt with 10 debts is always going to work faster because the debt snowball will be able to be created sooner. And that's a critical piece here, right? But one of the things we also say is once we execute these plans, once we get them in place, there's also this piece where I know that life is going to happen. I know I'm going to have to buy a new car. I know at some point I'm going to need a new roof. My hot water heater is going to go out. I'm going to need a new refrigerator. Whatever. Life happens. And this is just a plan, and we can always manipulate the plan. So the example thing I want to show you guys today is this is one of my clients. We just placed her policy today, actually. And let me do this. Okay. So this is her original plan. So we ran an original plan about 2 months ago. So this is what her situation was 2 months ago. She has a house and she's got 8 student loans. None of the student loans are large, and the house isn't particularly large. Okay, so she's in pretty good shape 2 months ago. Fast forward, this is what she looks like. $190,000 in debt. True debt's $390,000. Tom, if you can see that, can you confirm that you can see that? I can't see you. Just say yes.
Yes,
or anybody.
Chief. Yes, Chief.
All right, you can see it?
Yes. Yes.
Perfect.
Yes.
Okay, so this is what her plan looked like 2 months ago, right? So let's fast forward. This is what happened today. So she's got more debt. Moreover, she's got a pretty large one that she added in, $5,600. Okay, she's still at 29.6 years getting paid off in her current situation. She's added about $1,000 in real debt with the interest and everything. But when you go back to the original illustration, she's out of debt in 12.7 years. You guys see that? That's pretty cool. And she's gonna save $44,000 in interest. That's pretty strong. But because she added that one debt, this is what happens now. 10.4 years and $55,000 in interest saved. It's huge, right? Why is it huge? Why is it doing that? It doesn't make any sense that if you add more debt, your plan works. It shouldn't work faster, but it does. And that's because, remember, our plan takes into consideration 2 key things: infinite banking and debt snowballing. So in this scenario, that debt snowball, and it wasn't a large debt, it's $131 a month. That $131 a month is going to create that snowball. Before we pay off her house, it's going to jump it up to $408 a month. And in the previous plan, the snowball was only $316 a month. So that $131 that we added in is actually going to make the plan work faster. It's crazy. Moreover, on the original plan, which is pretty good, $118,000 of scheduled debt, paying off $44,000, saving $44,000 in interest. She's got $452,000 liquid in 30 years. That's strong, especially considering she's only running a 20-year plan. So that last 10 years, the thing's just growing by automatic. In our new version, we're at 635. Let me see, let that sink in here. 635. 420, 452 to 635 simply by adding a debt. So I call this the bigger, better, faster boom plan. So what are we doing here? These are the actual numbers from this actual client for what actually happened. 29.6 years to be debt free in either plan, $118,299 in scheduled interest for either plan. And this scenario, we're 2 months further down the line, so we've paid off a little bit of our other debts, but we've added a net total $1,629 in added debt. And that added debt, simply by adding the debt into the mixture, caused us to save 24% more interest, caused us to get out of debt 18% faster, caused us to have 74% increase in liquidity at age 50, caused us to have a 47% increase in death benefit at age 50, caused us to have a 40% increase in liquidity at the end of the run in 30 years, caused a 44% increase in death benefit in 30 years. And finally, what we're taking as a payment every year is tax-free income. We went from $23,000. It's the same, folks. This is the same plan. It's $671 a month of focused money where she was overpaying on certain bills. It's the same plan, same dollars, same everything. It's just she added a debt, and we're 2 months further down the line. That's the only thing that changed. And we increased from $23,000 to $28,000 a year that she's going to be able to take as a tax-free interest. So when you're looking at doing these things for yourself or for your family or for your clients, one of the critical things we should always be focused on is, remember, this is just a plan. And plans are meant to, they're going to change. And anytime, this is from military days, no plan survives contact with the enemy. And in this scenario, debt is the enemy, okay? But it's okay. We want you to go out and do the plan. We want you to go out and incorporate some new debts. We want you to live life. And in the process of incorporating these new debts, stay with the plan. Refocus your debt. Make it work for you permanently. And that was the, for me, I've done a lot of these. I've seen those numbers a lot, but I've not actually gone through the process of doing the math and actually illustrating them side by side. So you guys are the beneficiaries of something that my client asked for me to do for them. So there you go. So there you go, guys. Bigger, better, boom. And that's adding more debt makes your plan work better and faster for you. So I got a couple of questions down here, maybe. This is okay. No real questions. So if anybody's got any questions, we got a few minutes. I got about 15 minutes. That's my attack Chihuahua Chico saying he's got a question. I'm not listening to him. Look at Taylin. I want to visit Taylin. Nobody's got any questions. I did a great job of explaining it. This is awesome.
You did, Scott, you did. And as far as I can tell, can we get the charts from Melody Baldwin?
Can we get the charts? I'm not sure what you mean by the charts. If you mean the DFL scenarios, I cannot. They are proprietary, and but you can certainly, once you have if you're an agent and you're certified for DFL, you can go run some yourself. If you're not an agent and you're here just to learn about this stuff, then you can talk to whoever invited you here and they can run some stuff for you. But the stuff I showed you tonight, that's real. That's actually a real live client, and I'm not gonna. It's secret, so I can show you on the thing, but I can't send them out because you'll be able to see who actually it is.
Just so everybody knows, when you go through the debt-free life training, you sign a series of non-disclosures, and there's just certain stuff that we can't share. But I would recommend you to go through the training if it's something you're interested in learning more about, or work closely with one of the agents that Scott had mentioned earlier.
Right. I do see a question from Jonathan. How soon can someone who buys the policy start paying off their debt? Depends on the size of your debts and the size of your premium. So remember that roughly somewhere between 62 and 68% of your premiums are going to go to buy paid up additions. And that paid up addition bank is where you're going to pull loans. So if you have a $500 a month payment, your paid up additions bank is going to be something like $320, $350. So that means you're going to be building up bank loan capacity about $350 a month. So if you've got a credit card that you owe $300 on, then you could make your first premium payment, take out a $300 loan, pay off a credit card. And that's exactly what you should do, because that's going to create it's going to create that debt snowball faster for you.
So Scott, if I could add on to that, if you don't mind. I'm working on a case right now where there's a lump sum to roll in. So what we're doing is we're structuring it based on what they can afford on a monthly basis going forward, and they've got about $10,000 that they want to roll in. By making enough space that they can buy $10,000 worth of PUAs without mecking it, they're going to send that money in right after the account's open. They're going to have access to that money, and they can begin to pay off their debts. And the way we think of it is we're transferring ownership of the debt from American Express or Citibank. We're transferring it to ourselves so that it's, the debt's in our control now. And we've just borrowed money against our money. We're paying ourselves off. And what we figured out is it's kind of a net gain of 5% on money you're borrowing, which I know sounds crazy, but it takes a while. You need to begin to look at the banks as they're borrowing money from you and giving you a 0.25% interest, and then they're lending it to other people and making the spread. All you're doing is building your own bank and doing the exact same thing.
Right. I've done an analysis on that, and the first year it's a net gain or loss of zero. The interest that you pay is going to be roughly equal to the interest that you earn. But the second year, it changes, because in the second year, you're probably going to have paid off some of that bank loan or all of it. There's one critical thing about this. Most of the carriers, once you take out a loan, you've got a year to pay it back before there's a permanent detrimental effect. So if you take out a loan for $500 and you pay it back in the same year, there's not going to be any loss of anything. You're going to get your full dividend. If you take out a loan and keep it beyond the first year, it is going to impact your dividend that you receive, but only slightly. And the truth is, our first year, the dividend's nothing. It's not really worth crying over unless you're dumping in $30,000 or $40,000. Then it's significant. But the second year dividend is really where it takes off. And the third year dividend is where this whole plan becomes a juggernaut. You can't stop it.
And just to kind of, thanks Scott for that. I have done some research on the companies and how they calculate dividend, and what Scott's referring to is part of the calculation is how long you've been with the individual carrier. So it definitely favors the longer plans. So you can imagine if you go out 10 years, 15 years, 20 years, the dividend continues to grow. One thing that I failed to mention when I was talking about transferring ownership of the debt, the way I'm thinking about that is, instead of paying Citibank the minimum payment, you're now paying the carrier the minimum payment. So that way you have more control over the debt. The minimum payment's still being paid. You've just transferred ownership of the debt basically to your mechanism, so you have a lot more control over it. And as Scott mentioned, there does come a time where the dividends and the interest are when let's say you're all out of debt and then you go buy a car, and so you borrow money from yourself. There is going to come a time where the interest on your bank and the dividend on your bank is going to pay that loan back for you. So basically, you're getting a car with no car payments. Scott, am I close on the mark on that?
Yeah, it sounds good to me. But it's all semantics. The way I think about it is I'm paying off my debt with the carrier's money, because ultimately that's what's happening. So got a couple questions over here. When is training available? You can check out the Symmetry website. They've got one coming up in August, I believe, for a debt-free life 2-day training event. You have to sign up for it and get registered for it, and you'll probably want to make sure you talk with your coach or your trainer to make sure that you and that person both think that you're ready.
By the way, Nancy Hardy, who's on this call, just finished it yesterday, and I was having a conversation with her today, and she did say that her head was about to explode. So.
Very good. So, so Nancy, to make it, if Larry McLean taught it, I got one thing to say. Now listen to me. That's a joke for those of you that are taking the training. I counted 51. Yeah. Now listen, I was counting tick marks every time he said that in the presentation. I counted 51 on the second day. So, see, what do you do if there's no extra money to be found to use for the premium? So the only people I've ever found that didn't do this plan or didn't want to do this plan were people that really aren't eligible for anything because they're not making their debt payments. If they're not making their debt payments, then you don't have any money to fuel the plan unless they want to come out of pocket where you're creating an additional bill for them. If they're okay with that, great. If they're not okay with that, then you're not going to be able to do anything for them. But here's the deal. If they are not making their debt service, then they're bound for bankruptcy. And if they're bound for bankruptcy, this plan is a waste of time. They're going to put money into it, and eventually it will get canceled out. Moreover, if you've got someone who just came out of bankruptcy, you make sure you call the carrier and do a risk assessment with them, because some of the carriers are really, really touchy about somebody who still owes money or has a bankruptcy that hasn't been discharged for more than a couple of years. So make sure you do your due diligence. That's all I see. Anybody else? There you go, Christian, hit it.
Hey, Scott, I got two questions. Talked about banks traditionally are around 4% interest, but what historically have the dividends be? Is there a general rate?
So Forrester's has the highest dividend that I've seen over the last 20 years, and that interest rate on their dividend was 8.7%. Forrester's does their crediting a little bit differently though. So Forrester's actually incorporates their base 4% guaranteed interest into that dividend. Mutual Trust separates them out. Lafayette, call them and ask them. I don't care for Lafayette too much. Okay, what else you got?
Okay, second part is, what's wrong with wearing pink?
I'm just a number man. Some people, unfortunately, with a litigious society like we are, anybody can sue anybody for anything. You're probably not going to win, but you can take a lawsuit to court, and then whoever you're suing is going to have to defend themselves and blah, 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 blah. It's just a pain. So, all right. Anybody else? Yay. All right, everybody. Thank you very much for coming. Got any questions? You can get a hold of me or somehow. Otherwise, we'll be back next week.
Go
ahead.
I was going to say, or your upline, or the Symmetry agent broker who invited you to the call.
Sure.
So, and Scott, just wanted to say thanks again. Appreciate the time that you invest in this. It's every time I bring somebody on it, they find it to be very, very valuable. So thank you for that.
Well, it's certainly my pleasure. I told you guys, I started this for me. It was for me with my clients, and I was very selfish with that. And then I opened it up to other people, and it has morphed into what it is now. So hopefully you guys get something out of it. I do this every week because I've got clients coming every week. So welcome to the party, everybody.
Thank you. I love to pick your brain.
Yeah, brother. Go out and help some families, everybody. Talk to you later.